One of the most common questions I receive from those that are inquiring about our flex payment mortgage, or also known as a reverse mortgage, is a concern that if they do a reverse mortgage, will all the equity be gone for their posterity? And that becomes an important discussion item. Well, that's a fantastic question. To answer that, I wanted to walk through just a couple of visual illustrations that may be helpful in giving perspective on this. So on a reverse mortgage or a flex payment mortgage, the thing that calls that mortgage due is the last person on that note and deed of trust to permanently leave the home for a period of 12 months or more. And so that's typically due to death of the last person on there or moving into a long term care facility for a period of more than 12 months. Those are the two most common things I see to do a flex payment or reverse mortgage. In most instances, one of the borrowers needs to be at least 62 years old. There are other options we have, even at a younger age, that we can look at. But I'm going to give you a client scenario I was working on last week. So they called, they were feeling a little bit strapped as their income was they were kind of on a fixed income, and with inflation, everything else, it kind of had stripped away their buying power, and they were feeling a pinch on their budget. So their situation is their home currently is worth $625,000. They currently owe $150,000 on their existing mortgage, and that payment that they're currently paying is about $2,000 a month on their principal and interest. They've got 24 more years to go on that. So, by the way, these borrowers are 65, and so they've got 24 more years to go. And I asked them the question, are you ever going to really pay that mortgage off? And they realized, no, we really won't, more than likely. And so the question becomes, what happens to that equity? Well, in their situation, one of the things that we can do, they were eligible on a reverse or flex payment mortgage to take out as much as $273,000 in equity against their property. So in their situation, we paid off the $150,000 that they had owing. So that reverses that payment. They no longer have that payment that they're paying every month. They still pay their taxes and insurance on their own, but that payment is now working backwards. And so interest begins to accrue on that loan. As an example on that, I'll kind of walk you through these. Uh, if the home appreciates in this particular market, the appreciation forecast we're suggesting 4.6% per year. That means that the home value would go up $28,750 that next year in additional value. So that'd make that value even higher. Well, on that 150,000, if a current example interest rate of 6.5% were the scenario, 6.5% in interest accumulating on that $150,000 balance that we just paid off on their first mortgage would be $9,750. So they would owe in this situation $9,750 more, or it'd be up to 159,750 is what they would owe next year. But in theory, that home has also gone up the 28,750, so far exceeding what the interest is accumulated on that. Interestingly enough, piece that a lot of people don't know is that if we're only using 150,000 and they have 273,000 available, that remaining difference of $123,000 goes and is an available line of credit to these borrowers down the road. And that credit line grows every year at whatever the current interest rate is plus 0.5%, making that 7% in this example. And so that credit line of 123,000 that's available, they can pull on it at any point for whatever they want. They're tax-free dollars because it's equity out of their home. Will continue to increase 8,610. So that's actually going to begin to grow over time and give them access to more funds over time. They can use that to pay their taxes, insurance for them if they want. If they need to buy a car, do improvements to the property to modify the home to make it more usable for them. All these things are it's completely available and to them on cash. And so even if you looked at the increase in amount they could draw each year plus what the interest accumulating, you add those together, it's still not as much as the appreciation. And I point this out because over time is what I found is that there typically remains a fairly stable equity position. Now, most of the flex payment and reverse mortgage options are variable rates, and that's why we can't guarantee that there wouldn't, that the equity wouldn't strip away if we went to maximum interest rates for an extended period of time and appreciation went to zero for an extended period of time. That's going to eat away at that equity, and so the history shows that really doesn't happen over extended periods of times. We'll get little bells or dips and curves on that. But that's not something that's really realistic of what we see on that. And so I point that out because there's typically for the posterity a significant amount of equity that's still left. The more important question comes to me of this as we've talked about it with these particular clients. I asked them, can you provide experiences for your family right now? I said, no, we're really just in survival mode. And I But we are getting by. And they said, we can muscle it out and make this do if that allows us to leave a bigger pile of equity to our posterity. And I asked them the question: is it more important that they get a pile of money or that you have experiences and memories with them? And when I ask it that way, most everybody's going to say experience and memories. Well, they weren't doing any of that. And so I used in a simple example of what if your budget's feeling a little bit tight, what if we went in and you're paying $2,000 a month right now? What if we just said $1,000 of that goes as additional cash flow for you? But what if you took $1,000, $12,000 a year? You now have $12,000 a year as a budget, an itemized budget to create experiences with your family for the next 24 years. They're going to remember that more than any pile of money that transfers and is typically spent right away. Uh, these are really cool mortgages that provide a lot of opportunities. You can get growth out of them. All this equity, the difference between what you owe and the value of the home is yours. If you're there for 5 years and decide that you want to sell the property and go buy another one, you just take whatever interest is accumulated plus what it's appreciated. The difference between all that, you take it as normal equity, put it as a down payment on your next one, and do another flex payment or reverse mortgage, and buy without a payment again. You have that latitude. It's not like this is a permanent solution. It's no different than a regular forward mortgage. You have title to the property and have complete control. And so there's a lot of cool components on that. The term flex payment is also there because if you choose, let's say that you ended up getting a job and had a lot of extra income coming in for a season, well, you can make payments on this if you want to. So you can pay it back down. As you pay it down, this line of credit actually grows and opens up even more and is still sitting there available to the client in the future. And growing at that growth rate, which is fantastic, so that they've got options. So that's where the flex component comes into this. So some of the highlights that are often misunderstood: if you've got a loved one, or if this is a scenario that resonates with you and you're wondering what would my situation look like, very easy to run this custom scenario. I want to hear what your pain points are, what you're trying to solve for, and really be able to shed light on the cool options that are available in this type of a flex payment mortgage. So hopefully that's helpful. Feel free to call me at 801-614-5125, or shoot me a direct message or email me at brett.mills@guildmortgage.net. Would love to run those scenarios for you.